Hello everyone and welcome to this new edition of a video recording on the banking segment. In this video we are going to talk of a very interesting subject, a fascinating one, for it concerns the history of Indian banking. We are going to see how Indian banking evolved, or rather how it started, then it evolved, then it developed, and finally where we are today in terms of Indian banking. This is a fascinating insight into the journey of Indian banking, if I may call it so, because Indian banking has had its roots very early in the 18th century itself. And to think that we are now in the 22nd century or the 21st century, we are indeed proud of being an Indian, that Indian banking has come a very long way. The first Indian bank, or the first bank in India, was established in 1770, Bank of Hindustan, followed by the General Bank of India in 1786. Not surprisingly, both were established in Kolkata first, and the first bank which was fully managed by Indians was the Audh Bank, or the Audh Commercial Bank, founded in 1881. So we can now trace the history of Indian banking back to the 18th century. 1786 was when the first General Bank of India was formed, and in 1770 the Bank of Hindustan was formed. So we can be justifiably proud of the fact that India has been a precursor to the banking segment, and 330 years have passed since the earliest bank in India was formed. That the banking system is still holding good in India, and it's a very robust and strong financial system, speaks volumes of our country's financial discipline. The Bank of Bengal was established in 1809. Obviously, the Bank of Bengal had its origins in Kolkata. For Calcutta was Calcutta as it was then called, was the first port of call for the Britishers who came to rule India through the East India Company. So Calcutta was a very prosperous city, and no doubt that the Bank of Bengal was established there in the year 1809. The Bank of Bombay was established in 1840, and followed by the Bank of Madras was established in 1843. These three together, the Bank of Calcutta, which was established in 1809, or the Bank of Bengal was established in 1809, the Bank of Bombay was established in 1840, and the Bank of Madras was established in 1843. These three together were known as the Presidency Banks, because they were in the three presidencies of Calcutta, Bombay and Madras. The earliest nationalized bank, if you may call it, one of the nationalized banks, one of the current nationalized banks, and the earliest amongst them was the Allahabad Bank, which was established in the year 1865. That is almost 350 years ago. 1865 was the establishment of the Allahabad Bank. Now it is still called the Allahabad Bank, and this was established, and it has crossed the 350-year milestone. Punjab National Bank, yet another bank which is now nationalized, was formed in the year 1894. Punjab National Bank started off as a regional level bank, but later on grew in magnitude, and today it is one of the foremost nationalized banks, one of the foremost public sector banks, having branches all over the country and having established a name for itself. Between 1906 and 1913, a number of banks were established. The following were established between this period, 1906 and 1913. There were the Bank of India, the Central Bank of India, Bank of Baroda, Canara Bank, Indian Bank, and Bank of Mysore. Of the lot, except Bank of Mysore, the others have all been nationalized and they retain their names, whereas the Bank of Mysore was later on converted into the State Bank of Mysore. And as we know, on the 1st of April 2017, State Bank of Mysore was formally merged with the State Bank of India. So the Bank of Mysore, having had a rich cultural heritage of more than 100 years, does not exist as we talk today. However, all the other banks are still in existence and doing yeoman service to the cause of the Indian public. So the history of Indian banking can be traced from 1786, when the first General Bank of India was formed, and from there on it has grown by leaps and bounds, and today we have many nationalized banks, or the public sector banks, which are well over 100 years old. For example, Bank of Baroda, Central Bank of India, Indian Bank were all established in the period between 1906 and 1913. In 1921, all the three presidency banks, namely the Bank of Calcutta, the Bank of Bombay and the Bank of Madras, were merged, and they were merged to form the Imperial Bank. The Imperial Bank, of course, was run by the British, not by the Indians. When in 1921 all these presidency banks were merged and formed the Imperial Bank of India with its headquarters in Mumbai, at that time there was no RBI. The RBI was actually formed in 1935 following an Act of Parliament called the Reserve Bank of India Act of 1934. You just see how the history has been evolving. First, there were local banks called the General Bank of India and Bank of Hindustan, both started in Kolkata. Then the first Indian managed operated bank called the Bank of Oudh. Then we had the Allahabad Bank, which was formed in 1865. Then you had the Punjab National Bank. Then you had between 1906 and 1913, we had the Central Bank of India, Indian Bank, Bank of Mysore. All these banks were formed. Then in 1921, the three presidency banks which were formed in the 19th century, namely Bank of Calcutta, which was formed in 1806, Bank of Bombay, which was formed in 1840, Bank of Madras, which was formed in 1843. All these were merged to form the Imperial Bank of India in 1921. Still, there was no monetary authority to regulate all these banks. The monetary authority in the form of Reserve Bank of India was formed in the year 1935 following an Act of Parliament called the RBI Act of 1934. The Banking Companies Act was enacted in 1949 and was subsequently renamed as the Banking Regulation Act of 1949. The Banking Regulation Act of 1949 is a Bible for all bankers, and this was formed well more than 100 years after the first bank in India was formed. The Banking Regulation Act was formed in it was originally called the Banking Companies Act, and later on it was renamed as the Banking Regulation Act of 1949. As I have been repeatedly telling you throughout the course of these videos, the Banking Regulation Act of 1949 may appear dated when we talk in 2017, but the provisions of the Banking Regulation Act are very, very relevant and very, very current even today. Although there have been several amendments to this Banking Regulation Act, but most of the provisions remain the same, and they are very relevant and current even till this day. In 1955, the Imperial Bank of India was nationalized and was renamed as the State Bank of India. This saw the birth of the country's largest bank, State Bank of India, which was then called the Imperial Bank of India, was being run by the British. But after independence in the year 1955, the government of India nationalized that bank and renamed it as the State Bank of India. State Bank of India, from its humble beginnings in 1955, has become a mammoth organization today. And especially after the merger of the associate banks with it, State Bank of India has become the fourth largest in the world in terms of number of branches and amongst the top 50 in the world in terms of the asset size. State Bank of India, incidentally, was again formed under an Act of Parliament called the State Bank of India Act of 1955. Today, State Bank of India can boast of being amongst the top 50 banks in the world, but it had very humble beginnings when it was formed out of a nationalization of a British bank called the Imperial Bank of India. The history of Indian banking cannot be complete without the period between 1913 and 1917, when there were a lot of banking crises, and the failure of 588 banks in various parts of the country during the decade ended 1949 underlined the need for regulating and controlling commercial banks. Between the period 1913 to 1917, and especially in the decade ended 1949, 588 banks failed in India. This necessitated the formation of a central monitoring authority, and along with it the enactment of a Central Monitoring Act, and thus was born the Banking Regulation Act of 1949. It was started originally as the Banking Companies Act in February 1949, and subsequently it was amended to read the Banking Regulation Act of 1949. This act provided the legal framework for the regulation of banks in India. Banking Regulation Act provided the legal framework for the regulation of banking in India. As I told you, the largest bank, the Imperial Bank of India, was nationalized in 1955 and renamed as the State Bank of India. This was followed by the establishment of 7 associate banks. The 7 associate banks in 1959, there were 7 associate banks which are actually functioning in the princely states which founded them. They were the State Bank of Mysore, the State Bank of Travancore, the State Bank of Hyderabad, the State Bank of Indore, the State Bank of Saurashtra, the State Bank of Bikaner and Jaipur, and the State Bank of Patiala. All these were princely states. All these were princely states in the erstwhile India, and with the abolition of the privy purse, the princes, the respective princes were no more called the patrons of these banks. So these banks were nationalized from being Bank of Mysore. That bank became State Bank of Mysore. From Bank of Patiala, it became State Bank of Patiala. From Bank of Travancore, it became State Bank of Travancore, and so on. So this nationalization of the associate banks took place in the year 1959. And as of 1959, there were 7 associate banks and 1 State Bank of India. But however, as we have seen on the 1st of April 2017, these associate banks were merged with SBI to form a single large entity called the State Bank of India. And of course, the biggest moment in Indian banking history came on the 19th of July 1969, when 19 commercial banks were nationalized during the regime of the former Prime Minister, Mrs. Indira Gandhi. It was felt at that time that these banks were too large in size to be privately owned and operated, and hence they were all brought under the ambit or the control of the Government of India through the Reserve Bank of India, and 19 banks were nationalized as of 19th of July 1969. In fact, the process started in 1969, and by 1980, all the 19 banks had been nationalized. So the banks which were then nationalized in the year 1969, which was completed by the year 1980, are the Indian Bank, the Indian Overseas Bank, the Syndicate Bank, the Vijaya Bank, the Canara Bank, the Corporation Bank, the Allahabad Bank, the Punjab and Sindh Bank, the Punjab National Bank, the Central Bank of India, Bank of Baroda, and then the United Bank of India and the United Commercial Bank of India. So all United Commercial Bank, which is renamed later on as the UCO Bank. So all these banks were nationalized on the 19th of July 1969, and it took 10 long years for the integration process to happen and for the banks to be formally announced, and by 1980 the nationalization process had been completed. It is worthwhile to note that all these banks have gained a tremendous amount of momentum after they were nationalized, because government funds were induced into the banks, and these banks were then made the public sector banks in the country. However, there were certain rigidities and weaknesses observed in the banking system, and so the government during the late 80s, a high-level committee on the financial system was established on the 14th of August 1991. By 1980s, there were many rigidities and weaknesses which were found in the banking system. So the government appointed a high-level committee on the high-level committee on the financial system on the 14th of August 1991. This committee was formed to examine all the aspects related to the structure, organization, functions and procedures of the financial system. In 1978, another landmark was reached when the Deposit and Credit Guarantee Corporation was formed. The Deposit and Credit Guarantee Corporation, the DICGCI, is a wing of RBI, and it protects the depositors' interests by giving them insurance for their deposits and also for borrowers for their insurance against their loans. The deposits, although it is called the Deposit Insurance Corporation of Deposit and Credit Guarantee Corporation of India, the deposits covered under the DICGCI are insured up to a maximum of Rs 1 lakh only. which means that when a bank fails, or if a bank fails, the deposits can be recovered from the DICGCI only to the extent of rupees 1 lakh. This is indeed a very, very pertinent point to be noted. Another milestone in the history of Indian banking was reached in 1975 when the regional rural banks were established. We have already seen in detail about the RRBs and how they were formed and how they were restructured following large-scale weaknesses in the system, and then how the restructuring happened from 198 RRBs which were formed. Then it became 58 RRBs by 2005, and the further consolidation had taken place by 2012. So the RRBs saw the origin of the year 1975, saw the formation of the RRBs. The RRBs were formed as a means of reaching the credit to the credit and banking system to the last mile rural citizen. The RRBs were formed mainly with a view to helping the rural citizen enjoy the benefits of commercial banking. By the end of 1974, 3 separate institutional arrangements, commercial banks, cooperative banks, and RRBs had emerged. You just trace the history as I have been telling you thus far. By 1975, RRBs were established, the cooperative banks were already in existence, and of course the commercial banks were already in existence from the 18th and 19th century onwards. So by the end of 1974-75, 3 clear, well-marked institutional arrangements had developed. One was the commercial banking sector, one was the cooperative banking sector, and the third was the regional rural banking sector. In 1982, the NABARD, or the National Bank of Agricultural and Rural Development, was formed. This was formed in order to help agricultural credit reach the agriculturalists at the right time, and this was also formed as a monitoring authority to monitor and regulate the regional rural banks in the country. Subsequently, the Export-Import Bank of India, or the Exim Bank, the Small Industries Development Bank of India, or SIDBI, and the National Housing Bank, or the NHB, were also formed. Exim, SIDBI, and NHB are development banks taking care of the development of their particular sector. Further history was made in Indian banking and financial system when in 1988 the Securities Exchange Board of India was formed. The Securities Exchange Board of India, or SEBI, is the foremost regulator of the capital markets in India. SEBI regulates capital markets like mutual funds. SEBI also regulates the stock exchanges. SEBI also regulates the various aspects connected with the capital markets. Of course, we shall see about SEBI in greater detail in a later video. Since 1991, the Indian financial system has undergone radical transformation that led to the development of the non-banking financial companies, that is NBFCs, and the development financial institutions, or DIFs as they are called. Based on the recommendations of the High-Level Committee on Financial System, a comprehensive review of the banking system was introduced in 1992-93. Another high-level committee on banking sector reforms under the chairmanship of Mr. M. Narasimham was constituted by the Government of India in December 1997. RBI also issued fresh guidelines on migration to Basel II framework on capital adequacy. The Basel II conference in Switzerland formed a high-level committee to monitor the regulation of banks across the world, and they formulated certain capital adequacy norms. Capital adequacy is nothing but the bank has to have a certain amount of minimum capital in order to protect the interests of its depositors and the borrowers. So that the capital adequacy norms were formed as the result of the Basel Committee meetings, and the capital adequacy has since then become a buzzword in Indian banking history, because every bank has now to adhere and has to conform to the Basel II norms on capital adequacy. There are various stages, there are various tiers of capital adequacy, tier 1, tier 2, and tier 3. We shall deal with capital adequacy in separate detail, in greater detail in a separate video, which will follow sometime later. But for the present, just understand that there was this Basel II framework which was formed. Basel II framework based on a conference based on a conference held in Switzerland in the late 1990s, and that committee, which was formed to regulate international banking, also proposed, and the recommendations were accepted by the members of the committee, that certain capital adequacy norms have to be established for the banks. As we can understand the meaning of the word capital adequacy, that means the banks would have to have adequate capital with themselves to ensure that they are able to protect the interests of the depositors, who are their foremost customers, and of course the borrowers also. So that is why these capital adequacy norms were followed, and the Reserve Bank of India now is very, very strict in ensuring that banks adhere to this capital adequacy norms. No bank can establish this no bank can escape this capital adequacy norms, and it is being monitored by RBI on a quarterly basis as to each and every bank whether they follow these capital adequacy norms or not. Another milestone was reached in 2002 when the Securities and Reconstruction of Financial Assets and Enforcement of Security Interest Act were formed. This has facilitated the non-performing asset management by banks more effectively. We have to understand two things here. One is, what is securitization? What is securitization, and what is NPA? And what is reconstruction of financial assets? All these three words are important here. The securitization means when a bank gives a loan, let's say a bank gives thousands of loans every year, and some of them may turn out to be bad. The banks are now empowered, or the banks are now entitled to securitize them with another financial agency. That means it's a kind of a refinancing arrangement. The bank can sell its assets to another financing agency and get the money back. And reconstruction means rescheduling of a bad loan. So these two acts were formed in the year 2002, the Securities and Reconstruction of Financial Assets and the Enforcement of Security Interest Act of 2002. They were formed in the year 2002, and this has helped the management of NPAs by the banks more professionally. What are NPAs? NPAs are nothing but non-performing assets. Non-performing assets are called NPAs. They are called NPAs. What is a performing asset? First of all, what is an asset for a bank? An asset for a bank is nothing but the money due, the money owed to it by the borrowers. That is an asset. The deposit is a liability, whereas a loan is an asset. And when the loan is being repaid on time, and when the interest is also being serviced on time, that is called a performing asset. Now, those loans which are not being repaid on time, and those loans on which interest is not being serviced on time, is called a non-performing asset. As simple as that. Now, the definition of a non-performing asset has undergone a slight change from the earlier days when it was first introduced. Earlier, it used to be that when the assets were not performing, or when the loans were not being repaid for a period of 6 months or above, and when the interest has not been paid for 6 months or above, the loans were classified as non-performing assets. But since then, the RBI, in order to introduce more financial discipline on the banks, has introduced stricter guidelines and said that any asset on which the interest has not been paid for a period of 3 months, and any asset or any loan which has not been repaid for a period of 3 months, has now to be classified as a non-performing asset. What is the effect of classification of non-performing assets on banks? The banks have to provide for these non-performing assets out of their profits. It's as simple as that. The banks have to provide for the non-performing assets out of their profits. That means that whenever the banking, whenever a bank has got a higher degree of non-performing assets, then the larger amount of profits will have to be wiped off from their books of account. So the banks are very, very careful not to allow these NPAs to grow. The NPAs have become a very great talking point amongst the banking circles, and any bank which has got an NPA much higher than the national average is under greater scrutiny. So that means the borrowers also fall into a better discipline of repaying the interest and their loans on time, and the banks also are forced to go after their borrowers and recover the interest and the amount outstanding as per the terms of the agreement on time. So these two acts of 2002 enabled the banks to manage their NPAs in a much better way. NPAs are indeed a source of drain on the bank's profits, and no bank would allow its hard-earned profits to be wiped off by non-performing assets. So that is the reason why the NPA management has become very critical. This company, Narasimham Committee, submitted its report in 1998. Some of the recommendation committee are on prudential norms, capital adequacy ratio, classification of government guaranteed advances, provisioning and requirements and standard advances, and more disclosures in balance sheet of banks were adopted and implemented. So these are some of the stringent provisions which were recommended by the Narasimham Committee and which were later on adopted and implemented by the commercial banks. What are the recent developments in the banking history in India? When we talk of recent developments in the banking history, the recent developments need not have happened yesterday or day before, but we are talking of a 350-year-old or 350-year plus old history of Indian banking. So we are talking of developments which have taken place in the recent past, which means that in the last 10-15 years or so. The recent major initiatives includes guidance to banks on asset liability management and integrated risk management systems, compliance with accounting standards, consolidated accounting and supervision, fine-tuning on the prudential norms for income recognition and asset classification, and provisioning for NPAs, etc. We already have talked of provisioning of NPAs and how it affects the balance sheets and profit and loss account of the commercial banks. The RBI has also introduced major structural changes or major structural reforms on asset liability management. In other words, what is asset? The loans given by the bank to the borrowers. The liability is the deposit taken by the bank from the depositors. An integrated risk management system. Banks have to evolve an integrated risk management system, which means that they have to formulate certain procedures and rules in order to manage this risk arising out of loans, arising out of bad loans more effectively. And compliance with accounting standards. Accounting standards have also been laid down for banks by RBI. It is not that each bank can follow its own accounting standards. There are certain broadly classified accounting standards which have been prescribed by the RBI, and each and every bank, whether it's a private bank or a public sector bank, has to adhere to these norms of accounting standards set by RBI. And consolidated accounting and supervision, fine-tuning of prudential norms for income recognition. Income recognition, as I told you, when the non-performing assets are there, the income or the interest charged, if it is not paid, then it cannot be recognized as income. That is one of the basic features of the prudential norms on income recognition. The bank's major source of income is the interest from the borrowings which it has lent, or the interest from the loans which it has lent. So the banks can actually provide for interests which are receivable by the bank from its borrowers for the next quarter, let us say. However, such income cannot be recognized as income unless and until they are actually received. So that is the meaning of prudential norms on income recognition. You cannot recognize an income unless it is actually received. So that is the basis on which banks are supposed to do their accounting standards now, and this has become very, very strict for all the banks. The basic aim, let us understand, of the RBI in doing all this is to ensure that banks present a true and fair picture of their financial stability and of their financial status to the stakeholders. The times have gone when banks used to camouflage their balance sheets and show a very healthy picture and saying that all is well. But today, it is all laid bare. It is laid bare to the extent that banks have to show their exact picture. What are their assets? What are their liabilities? What is their income? What is their expenditure? What is the income actually received? And any income which is receivable but not received cannot be taken into account into the income recognition part. So, for example, there could be many loans on which interest has been applied to the loan but not paid by the borrower. That does not become an income for the bank in as much as the income has not been actually received. It might have been generated but not received. And such income cannot be termed to be a part of the bank's income. That is what the RBI is trying to convey here. And asset classification, as I told you, non-performing assets and performing assets, and provisioning of non-performing assets. As I told you, every bank has to provide for non-performing asset if the asset remains non-performing for 3 months or more. Some of the more some more recent developments which have taken place in the banking history in India are the setting up of offshore banking units in special economic zones. What is special economic zone? Of course, we'll have to know that. What is special economic zone? We will of course see that in detail in a separate video. There's a special economic zone is nothing but a zone where there are only export-oriented units. That is called a special economic zone. Fair practices codes for lenders, corporate governance, anti-money laundering measures. We saw in a video on Prevention of Money Laundering Act. So that's part of the RBI's move to ensure transparency in the banking system. Know your customer norms. This is indeed very, very important and very, very necessary to understand what is know your customer norms. And corporate debt restructuring derivatives, guidance notes on credit risk, market risk, operational risk, etc. are other important developments introduced in the banking sector in recent years. So there have been a number of developments in the banking sector in the recent years. RBI has been continuously trying to imbibe a certain sense of discipline and culture in the banking system, and that is why I told you right at the beginning of this video that the Indian banking has seen development, growth, evolution, and finally the recent developments. Evolution is all a part of the evolution system. The evolution has taken place over a number of years. It is not that evolution has taken place overnight. One of the recent developments, of course, is the prevention of money laundering, which we have already discussed in a separate video in great detail. And the other thing which I wanted to explain to you in some detail now is the know your customer norms, or the KYC norms. Some of us who are familiar with the banking sector as of today, as a customer, may be familiar with the word KYC. KYC is nothing but know your customer. Every bank is supposed to know its customer to the maximum detail as possible. The KYC norms includes verification of the proof of address, the proof of identity, the name, gender, the age, the date of birth, and of course the income details of the client, and his telephone number, email ID, landmark of his residence, his official address, etc. All these are part of the KYC process. The banks have to get these KYC details from the customers. Even old customers who have been with the banks for long have been asked to fill up KYC forms, because the RBI is very clear that a bank cannot deal with a stranger. The banks have to know their customers to the extent that they should know where the customers are living, what these customers are doing for a living. They should know what is their identity proof. They should know what is their address proof. They should know what is their Aadhaar number, for example, and they should know where exactly they live, to the extent that the landmarks have to be provided. They should have their contact numbers in case of any emergency, where to contact the bank, where to contact the customer, both the mobile and the landline numbers. All these have to be filled up in a KYC form. So this development has come very recently, and now that's why we find banks asking us to link Aadhaar accounts with Aadhaar numbers with bank accounts. We very often come across instances where if people have not updated their mobile number with the bank will ask them to update their mobile number, their email accounts, so that all communications can be sent across by email and by SMSs if necessary, and also by hard copy letters. That is why these KYC norms are followed in very, very strict detail nowadays. So this is part of the evolution of Indian banking. The landmark in Indian banking history after the period of nationalization of Imperial Bank of India, which was later named as State Bank of India, and the nationalization of the 19 commercial banks as on 19th July 1969. The next landmark was reached in the year 1993, when private banks or private sector banks were allowed to set up shop, or the so-called new generation private sector banks were allowed to set up shop. It's not that private sector banks were not in existence before 1993. There were many old generation private banks which are still in existence. For example, the Karnataka Bank, the Dhanlakshmi Bank, the Catholic Syrian Bank, the Tamil Nadu Mercantile Bank, the Ratnaka Bank, and so on and so forth. These are all established long back, decades back, and they have won the trust and loyalty of their customers over decades of customer service. It's not that before 1993 private sector banks were not established at all, but the 1993 was the year in which the new generation private sector banks were allowed to establish. The new generation banks were allowed to establish with a view to induce greater competition and so that not to induce a sense of complacency in the public sector banks, the new generation private sector banks were allowed to be set up. These private sector banks which were allowed to be set up were HDFC Bank, ICICI Bank, Yes Bank, Kotak Mahindra Bank, Axis Bank, Bandhan Bank, IDFC Bank, and of course IndusInd Bank. All these 8 banks were introduced, were established from the year 1993 onwards, not necessarily in the chronological order, but in terms of chronological means in terms of the date of setting up, not necessarily in that order, but the 8 banks which were allowed to set up are HDFC Bank, ICICI Bank, Kotak Mahindra Bank, Yes Bank, IndusInd Bank, Axis Bank, Bandhan Bank, and IDFC Bank. If you have a look at it closely, all these banks are associated with some financial institution or the other in a major way. Perhaps with the exception of Yes Bank, all the others were associated with the some kind of financial institution or the other in a very major way, and they were promoted by these financial institutions. HDFC Bank was promoted by HDFC Limited, which is a premier housing finance company in India. ICICI Bank was ICICI Bank Limited was promoted by ICICI Limited, which is called the Industrial Credit and Investment Corporation of India, which is again a very famous financial institution. Kotak Mahindra Bank was established by the Kotak group of companies which have varied interests in the financial services, and they have interests in insurance, they have interests in mutual funds, they have interests in stock market, they have interests in a lot of financial services institutions. Kotak Mahindra Bank was established by Mr. Uday Kotak, and it is of course now a publicly listed company. And Yes Bank was perhaps an exception to this list. It was not founded by any financial institution as such. It was founded by Mr. Rana Kapoor, and the bank has made rapid strides in the private sector space in India. IndusInd Bank was established by the Ashok Leyland and Hinduja group of companies, that they formed the IndusInd Bank. Axis Bank was earlier actually promoted by UTI. It was called the UTI Bank Limited. Later on, the name was changed to Axis Bank. UTI continues to be a major shareholder in the Axis Bank Limited. Bandhan Bank was established by the famous NGO Bandhan of Calcutta. They have now branches all over the country. The NGO, of course, has been a very big NGO covering almost the entire country. And IDFC Bank was established by the big financial lending arm, Industrial Development Finance Corporation of India. So all these banks were actually formed by the promoters of the various financial institutions. And these 8 banks are called the new generation private sector banks. Because there are a set of private sector banks which were in existence much longer. They have in existence. A bank like Dhanlakshmi Bank, for example, has completed almost 80 years of existence. The Catholic Syrian Bank has almost completed 75 years of existence, and so on. RBI has issued detailed guidelines on ownership and governance in private sector banks on 28th of February 2005. The underlying principles of these guidelines are to ensure that all banks in the private sector have a net worth of 300 crore rupees at least. To ownership and control of private sector banks is well diversified. Important shareholders conform to the fit and proper criteria. There are a couple of things to be noted here. What is net worth? RBI has said that all private sector banks should have a net worth of more than 300 crore rupees. Net worth is equal to assets minus liabilities. This is called the net worth. So all the banks, all the private sector banks have to ensure that they have a net worth of 300 crore rupees at all times, which means that they should have in their reserves 300 crore to meet any unforeseen emergency in the case of a run on the banks. So the ownership and control of private sector banks should not be held with one individual or his family. It should be well diversified. That is why all these private sector banks have gone in for public issues. Although the promoters may still hold somewhere close to 20% stake in the company, but still it is not a majority shareholding. Although they were founded by one or more promoters, the promoters have to diversify their holdings in such a way that the entire shareholding does not rest with an individual or a group of individuals. So the ownership has to be diversified, and important shareholders belong to the fit and proper criteria. What is fit and proper? Means that they have to be fit and proper means that they have to conform to all the financial disciplinary norms which are issued by the Government of India and the RBI from time to time. They cannot be convicted of any offences, they cannot be convicted of money laundering, etc., etc. The directors and CEO who manage the affairs of these private sector banks also should stay in the fit and proper criteria. It is not enough if the promoters are fit and proper, the directors and the CEO also should adhere to this fit and proper criteria, whereby they should not be convicted of any offence, etc. In 2007, RBI advised banks in the private sector to ensure that that their memorandum and articles of association conform to these above norms which we just discussed. Banks in the private sector were also advised to split the posts of the chairman and the managing director and CEO. Earlier, it was always called the CMD, the chairman and managing director. Now, the private sector banks have been asked to split the post of managing director and CEO and the chairman, that they should have a part-time chairman of the board of directors and a separate chief executive officer or managing director who shall be responsible for the day-to-day affairs of the bank. Why this has been done is to ensure that the chairman, who could be a director on many companies, will not be able to devote his entire time and energy to the day-to-day affairs or the day-to-day running of the bank. So the RBI said that keep the day-to-day affairs of the bank away from the chairman. Let the chairman be only let the chairman be only the head of the board of directors. But however, the day-to-day affairs of the bank have to be run by a separate managing director and CEO who has to be taking care of the day-to-day affairs. So this is a very latest move which has come from in 2007, and all the private sector banks in the country have been asked to conform to these norms. So this is how the history of Indian banking has evolved. From the first General Bank of India in 1786 to the current private sector banks, the new generation private sector banks, we've seen how the Indian banking started, how it evolved, how it developed, how it grew, and where it is today. Today, the Indian banking system is indeed a robust one. The Indian banking system is indeed a robust one that is particularly known or particularly confirmed by the fact that there have not been too many failures of banks in recent years. The last known merger of a private sector bank with the public sector bank was that of Global Trust Bank way back in the early part of the 21st century, when they were merged with the Oriental Bank of Commerce. Other than that, there have been no major banking mergers because of failures of banks. So it is indeed a matter of great pride for all of us Indians to know that the history of Indian banking is a long one, is a cherished one, and the banking system in India has withstood all the trials and tribulations of the periods of several centuries, and we have reached a stage where today India can boast of a very strong and robust banking system in the world. Indian banking system is one of the best in the world, and although we might have our own grievances as a customer, saying that the bank is not doing this, the bank is doing this, or it is not doing that properly, etc., etc., but taken in the overall context, I think Indian banks are doing extremely well. The banking system in India is indeed a very, very robust and healthy one, and it is here for all time to stay, or for all times to stay. So I think I took great pride in making this presentation on Indian banking system and the history of Indian banking system. I'm sure all of you would have enjoyed it as well. Please note the various timelines associated with this history and the various formation of committees, etc., so that you are able to answer any questions that come in the banking exams. And I'm sure you enjoyed watching this video in as much as I did making the presentation. So until I see you in the next video, is bye from me for now, and thanks for watching. Bye.